Hi, I'm teacher Jona of Accountancy, Business and Management. Welcome to our class in Fundamentals of Accountancy, Business and Management 2. Our topic for today is the Statement of Comprehensive Income, also known as the income statement. This shows the results of financial operations for a period of time, which gives us either the net loss or net income. It is being prepared for a month, for a quarter, or for a year. It uses the temporary accounts or nominal accounts. Why are they called nominal accounts? Income statement accounts are called nominal accounts because these are being transferred or closed to the equity or capital account. Thus, all the income statement accounts become zero at the end of the period. We have two approaches in doing the income statement, the single step and the multi-step approach. The single step is commonly used for service business, wherein the company would render service in order to generate revenue. The formula in the single step is total revenues less the total expenses will give us the net income. It's a simple form approach. While in the multi-step approach, this is a little bit longer than the single step, and it is being prepared normally for merchandising business. What is a merchandising business? Well, it is a type of business wherein the company would buy goods as it is, and they would sell it as it is with no production. They won't change the item itself. Then we have here I'm showing the illustration of the difference, the differences in the financial position and in the comprehensive income. I encircled the as of in the statement of financial position because it tells us that the report is cumulative. The accounts, the amounts in the financial position are cumulative from beginning of inception of the project up to the time it becomes zero. But in the statement of comprehensive income, we use the word for the year ended as it is encircled. If you will notice it again, because all the accounts in the income statement are being close to the equity accounts, and thus all of these accounts become zero at the end of the accounting period. Thus, they are called temporary or nominal accounts. Then we will be encountering the following terms. Sales. In the local parlance, we call it benta. Sales is the total amount of revenue generated. While the sales has a normal credit balance, as we have studied earlier, we also have this contra revenue. That means, or contra sales. That means you have to do the opposite of the sales. If sales has a credit normal balance, contra revenue or contra sales will have a yes, perfect. It's debit balances for sales returns and sales discounts or cash discount. What is a sales return? A sales return is an account used when you sold products and these items were given back to you because it has some defects or maybe the customer was not satisfied. Then we have sales discounts. This is an account used when the seller would give discounts or cash discounts to the clients because of prompt payment, meaning they paid before the due dates or even on the due date itself. So there is prompt payment on the part of the clients. This should not be mistaken with trade discounts because trade discounts are given when a customer or a client buys in bulk or in a wholesale. Then we have the purchases. When we say purchases, it means the total amount of goods that you have bought. Then we have here the contra purchases. When we say contra, again, it is the opposite. if the purchases as a debit balance, contra purchases will use what kind of balance again? Right. They use the the opposite of debit balance of purchases. So purchase discount and purchase returns use the credit balance. And what is a purchase discount? Well, this is the same with the sales discount, but this is on the point of view of the buyer. When you bought something and you were given a discount for your prompt payment, or when you paid before or on due dates, then you are given a purchase discount. Purchase return is an account used when the buyer bought something that has some defects, and when you return it, then you classify it under the purchase returns. Freight in. Freight in is the transportation cost we use when the buyer would order goods, and the transportation cost used in delivering the goods into your company or into your business, well, that's the freight in. Then the ending inventory is the amount of goods unsold at the end of the accounting period. Then we have here the selling expenses. These are expenses directly associated with the sale of merchandise. Example of this are the delivery costs or delivery expenses, or when we pay our marketing people. These expenses that are directly associated with the sale of the product, we call it the selling expenses. But we also have the general and administrative expense. These are the expenses incurred which cannot be associated with a sale but are necessary in the operations of a business. Then, for our next slide, we have the cost of goods sold. The cost of goods sold in Tagalog, we call it puhunan sa benta. So, this is the amount or the cost of the items that you have already sold. Then the beginning inventory is the amount of inventory at the beginning of the period. Normally, uh, the amount at the end of the previous year's balance becomes also the beginning balance of the inventory at the following beginning period. Then we have here the net purchases. Net purchases is equal to purchases less the purchase discount and less the purchase returns. That is different with the net cost of purchase. In net cost of purchase, you add the freight in. Freight in again is the transportation cost for buying the product. Then the gross profit, we have the net sales less the cost of goods sold. And the net income, when you deduct the gross profit less the expenses, we arrive at the net income. But don't worry, later I'll be showing you the entirety of the format of an income statement, so you will be guided when we do the exercise. Then we have here, here is, okay, I have shown here an example of a balance sheet. Yes, this is a balance sheet. What I was trying to emphasize here is the word as of. In the balance sheet, you may ignore using as of, or you may use the word as of. But in the income statement, you always use the word for the year ended, for the quarter ended, for the month ended, whichever is applicable. And this statement that is being shown today at this moment is called the single step format. See, it's very simple because it starts with the revenue, then deduct the expenses. You may classify the expenses as administrative and general expenses and selling expenses. Then, ergo, you immediately get your net income. But in the multiple step format, it's quite complicated. Okay, I want you to copy this because this is the complete format or complete listing of the contents of a multi-step approach in making a comprehensive income statement. So this it starts with sales less the contra sales or contra revenue less the sales returns and sales discount. Then you arrive at the net sales. Then from the net sales, you deduct your cost of goods sold, but the cost of goods sold has the following content: the beginning inventory plus the purchases, but if there is a purchase returns and purchase discounts, we deduct it from the purchases to arrive at the net purchase. Then we add the freight in. Then when we added the freight in, it now becomes the what? Correct, the net cost of purchases. Then it becomes the cost of goods available for sale. But when we deduct the ending inventory, then we arrive at the cost of goods sold. From the cost of goods sold, we deduct it to the net sales, which will give us the gross profit. From the gross profit, we deduct the general and administrative expenses, the selling expenses, and finally, we have arrived at the net income. So I want you to copy this, or maybe just to have a complete listing of this, because this is what we use in merchandising business. Then we have also the multi-step. Again, another example. I'm just showing here the format so that you may be able to be guided when you prepare the income statement. So this is the first page only. It ended with the gross, what's this? The gross profit. Then we have the gross profit up to the net income. See how complicated it is. But if you know the format, there's nothing difficult in it. Then we have the exercise 3. I have given here a very simple exercise for us to be able to practice our accounting, from the simple transactions to the preparation of the books of entry to the T accounts or the posting to the ledger and the trial balance. And finally, we can now prepare the income statement and the balance sheet. You may use whatever form is applicable. Okay, here is the question. It's 1 to 11, but in addition, there is an adjusting entry at the end of the year. The merchandise inventory is 200,000. We will do it one by one. So we will achieve the mastery in our problem solving. Number one entry, Juan made the following investments for his grocery. Merchandise 1 million, cash 1 million. So we debit merchandise inventory and we debit cash 1 million, 1 million. So it will give us 2 million for equity. Okay. Next we have number 2, ABC company paid rent for the building 50,000. So rent expense is a normal debit account, but we deducted our cash account, so credit cash 50,000. Next we have number 3 transaction is Juan made additional investment of merchandise 500,000. So when he made an additional investment, we debited purchases and credited equity. I would want to correct this again. Why did we debit purchases? Because in the periodic inventory system, yes, in the periodic inventory system, in order for us to be able to have a track of the costing of the goods that we have, we use the purchases account. Next, ABC company earned 3,000 sales from the grocery. So sales means a credit balance. So a debit, an increase of cash, 3 million, and a sales normal balance, say 3 million. Then we have Juan withdrew merchandise 200,000. So this is a drawing account of Juan. The drawing is a normal debit balance. But here, if you will notice, purchases was credited. Why did we credit purchases? Because um, we have to track the deduction in the cost of the purchases. So we credited purchases. This is an exemption to the rule, if you will notice. Because what are the contra purchases? We have the purchase discount and purchase returns. But in this case, we credited purchases because there was a withdrawal in the merchandise. Next, ABC purchased merchandise from XYZ 40,000. So again, you added your purchases account with 40,000 and a deduction in cash of 40,000. Number 7, ABC paid freight on merchandise bought 3,000. So you use freight in because you purchased. When you purchase something, you use the account freight in, but when you sell, I mean, you use the account title freight out. So a credit of cash because you deducted your cash by 3,000. Number 8, we have this returned merchandise to XYZ 1,000. So this is a purchase returns. So debit cash, you will receive cash from the return of the merchandise, but you have also to credit your purchase returns. Then we have number 9, received a debit memo for sales return from client Lita 5,000. So a debit memo or a credit memo, these are the documents you receive when there are returns in the merchandise bought or sold. Since this is a debit memo for sales returns, so you have a client, Lita, and he returned maybe some defective items. So you have to debit your sales returns by 5,000 and you have to pay back Lita cash of 5,000. Then bought equipment on account. Equipment, you added your asset account in the form of equipment, 100,000, and you incurred liability of 100,000. Here in number 11, paid salaries and wages, 100,000. So salaries and wages is a normal debit balance because that's an expense account. But because you paid salaries and wages, you deduct your cash account. And at the end of the year, the adjusting entry for the merchandise inventory is 200,000. So you debit merchandise inventory at the end, 200,000. Income summary, 200,000. The merchandise inventory at the end will appear in your balance sheet as a debit and in your income summary, in the income statement as your credit. Next, we will now prepare the ledger of the many accounts. I think there are only 3 accounts that have moved. I mean, there were changes. So we made the T account for cash, equity, and the one in red, the red marks here, number 1, number 4, number 2, number 6, number 7, number 9, number 11. This pertains to the transaction number. So transaction number 1, this is the account, number 2, etc. And after doing your ledger account in cash, you will arrive at a balance of how much is that? 3,803,000. For equity, you have a balance of 2.5 million. Then again, we have purchases account, a balance of 340,000. Then only the three only 3 accounts have changes, which is the equity, the cash, and the purchases. The rest, they remain the same, so we just copy them. Merchandise inventory, etc. Cash 3,803,000, merchandise inventory 1 million, up to equity. Then we have the trial balance. We now prepare the balances of the accounts. From cash, 3,803,000, merchandise inventory, 1 million, equipment, etc. until it arrived to a normal debit balance of 5 million, 5,601,000, and the credit balance of 5,601,000. So if you will be preparing the income statement for that, this is the result. Sales 3 million less sales returns of 5,000. So net sales of 2,955,000. The cost of goods sold, okay, the beginning inventory of 1 million, and then the rest follows. Then the second page of the multi-step format is this one. The gross profit less the general and selling expense. We have a net income of 1,703,000. And now, if you will try to prepare the financial statement of that, I mean the balance sheet, statement of financial position, here is the balance sheet of one grocery. Cash, 3,803,000. Merchandise inventory, take note, merchandise inventory is 200,000. Okay? Because there was an adjusting entry at the end of the year. So equipment, 100,000. Total assets of how much is that? 4,103,000. And so with the liabilities, 100,000. The equity beginning, 25 plus the net income, 1,703,000, and the drawing account, 200,000. Equity of 4,003,000. Total liabilities is total liabilities and equity will give us 4,103,000. So now here is your exercise or activity number 4 so that you can practice at home. You just follow the step by step procedure that I have shown you in this video lesson. Then that's all for today. I welcome you to our next episode on the statement of changes in equity. Again, I'm at your service. See you again. Thank you for watching. And I'm Teacher John.